Assalamualaikum warahmatullahi wabarakatuh. Thank you for giving me the honor of your time and attention. I would like to begin with the word of the center of this presentation, uncertainty. I didn't choose it because it sounds dramatic. I choose it because during the years of this doctoral research, the world made uncertainty impossible to ignore. We passed through a pandemic inflation shock, a sharp interest rate cycle, geopolitical tension, and even a backlash against sustainability itself. In that environment, my research asked one direct question. When market become anxious, does ethical finance actually change the price of capital? When I begin, I carry a simple belief. I believe Sukuk should naturally fit ESG because they are asset-linked, Sharia screened, and ethically grounded. But the data forced me to become more careful. It taught me that ethical value don't automatically become market price. They must first become credible, measurable, verifiable, and institutionally trusted. So today, I am presenting this thesis as a final word. I am presenting it as an innovation to rethink how Islamic finance can move from moral promise to market discipline and from beautiful principle to decision that truly shape capital allocation. Bismillahirrahmanirrahim. Wassalatu wassalamu ala Sayyidina Muhammadin wa ala alihi wa sahbihi ajma'in. I begin with the Surah Ar-Rum, verse 41, because this verse gives me entire presentation, its moral analytical foundation. The Quran tells us that corruption appear on land, on the sea, because of what humans have earned. This is not only a spiritual warning, it's also a profound economic statement. It tells us that environmental and social damage are not accident outside the economy. They are often the consequence of the way wealth is produced, financed, and distributed. That is why sustainability is not foreign to Islamic finance. It is something we borrow from the global ESG disclosure and then attached to Sharia compliant product. It's already embedded in the logic of accountability, stewardship, justice, and consequence. The question then is not whether Islam supports sustainability. The deeper question is whether our Islamic financial institutions have built the mechanism that allow those values to be recognized, trusted, and priced by the market. Let me guide you through the journey of the argument so the structure is clear from the beginning. The presentation moves in 5 stages. First, I explain the puzzle, why an instrument that appears ethically ideal can still produce weak and ambiguous pricing effect. Second, I discuss the theoretical foundation, stakeholder theory, legitimacy theory, signaling theory, and maqasid al-sharia. Third, I present the method which combine panel econometric with the analytical network process. Fourth, I show the evidence from both tracks. Finally, I translate the finding into an agenda for regulator, investor, and academics. The most important point is that the two tracks are intentionally keep spirit. The econometric model tells us what the market actually price. The NP model tells us what the expert believe should matter. I didn't try to force these two tracks into artificial agreement. In fact, the gap between them became the most valuable finding. It shows where ethical ambition is strong, but institutional translation is still incomplete. This puzzle that started the entire the research. On the paper, Sukuk and ESG look like natural partner. Sukuk are linked to real asset, they avoid prohibited sector, and their ethical legitimacy depend on the relationship between finance and the real economy. If any financial instrument should reward sustainability, then Sukuk should. Yet the empirical record is much less straightforward. Across the countries and year examined in this thesis, the average ESG effect on the Sukuk yield is weak, unstable, and often statistically insignificant. At the first, I found this disappointing, but slowly I realized that the problem was not the absence of ethics. The problem was the market couldn't reliably read the ethical signal. This becomes clearer when we look at ESG metric. Many ESG indicators still measure input, policy, pledge, committee, activity, and statement. Far fewer measure actual outcome. For Sukuk, this is a serious mismatch because Sukuk are ethically powerful, precisely when their proceed can be tied to real, very viable outcome. So the value is not moral, it is architectural. Ethical substance exists, but without credible disclosure, independent verification, and enforceable accountability, that substance remain economically silent. The market is going quickly, and the growth should be acknowledged. ESG Sukuk issue has expanded significantly, and the instrument is no longer a small niche within sustainable finance. In emerging market, it has become one of the most visible Islamic contribution to the global sustainability agenda. But I want to be careful here. Growth in the volume is not the same as a growth in the credibility. A market can scale impressively and still remain fragile if its verification infrastructure is weak. That is the central tension of this slide. The risks are already visible: greenwashing, evolving Sharia requirement, issuer concentration, and uneven post-issuance reporting. These are not abstract concerns. They affect whether investor can distinguish between an issuer that has genuinely delivered impact and an issuer that has merely adopted a label. My argument is therefore simple. The binding constraint is no longer demand. The market has shown that demand exists. The binding constraint is verifiability. If ESG Sukuk continue to scale faster than their credibility infrastructure, the reputational risk will be shared by the entire industry, including the most sincere issuer. These three questions carry the argument of this thesis. The first question is about pricing, which macroeconomic and ESG factor explain Sukuk yield, and do this effect remain stable across market condition? The second question is about preference, which ESG criteria do inform stakeholder actually prioritize. The third question is the most important one: when does ESG become financially material in Sukuk market? That word "when" changed the direction of this research. Earlier in the process, I asked whether ESG was priced, but the question was too rigid. It assumed that ESG pricing is either present or absent. The data resisted that assumption. Once I changed the question from whether to when, the research became more coherent. ESG is not priced continuously. It appears under a particular market regime, especially when uncertainty increases and investors become more selective. For a younger researcher, this is an important methodological lesson. Sometimes our model are not falling because the estimator is weak. Sometimes they fail because the question is too narrow. A better question can reveal a structure that a conventional question hides. The theoretical framework used for lens and each perform a specific task. Stakeholder theory explained why I needed to ask experts directly. ESG priorities are not produced by the market alone. They emerge from the interaction for regulator, scholar, issuer, investor, and practitioner. Legitimacy theory explained why institutions might adopt sustainability language without necessarily receiving a pricing benefit. Sometimes sustainability reporting is used to secure legitimacy than to change capital costs. Signaling theory explained why timing matter. Investors don't consume every single equal atom every moment. They pay closer attention when uncertainty is high and information become valuable. This is why ESG might matter more in the detail of the yield distribution than the average. Finally, Maqasid Sharia provide the normative anchor. It tells us what ought to be protected: faith, life, intellect, lineage, and wealth. But Maqasid doesn't automatically enter the market price. It must pass through institution. For me, this is the frontier of Islamic finance research. We no longer need to keep proving that ESG and Sharia are compatible. The real question is why compatible value don't always transmit into measurable financial outcome. This slide explains one of the most important choices in my thesis. I treat Maqasid Sharia as boundary condition, not as simple regression variable. What does that mean? It means Maqasid define the moral space within which Islamic finance should operate. It tells us whether an outcome is acceptable, not merely whether it's profitable or statistically significant. The econometric can tell us what the market register. Maqasid tell us what the market might be willing to see. This distinction matter because it allows us to measure an institutional gap. If the market price is governance, but the under which social justice, Maqasid help us recognize that this is not only a technical outcome, it's also a normative distortion. The most striking asymmetry is that classical Maqasid place life and lineage above wealth, while the market and expert priority structure give much greater influence to government and financial credibility than to income distribution, human right, or social responsibility. That doesn't mean people no longer care about social objective. It means those objectives have not been translated into measurable, enforceable, and investable criteria. Maqasid help us see the distortion clearly. This is the methodological core of this thesis: analytical triangulation. First track is market evidence. I begin with exploratory data analysis because estimator choice should be disciplined by the data, not by habit. Then I estimate a dynamic two-way fixed effects model to identify the conditional mean relationship while controlling for country and time effects. Finally, I use quantile regression to test whether the pricing function change across low, median, and high yield regime. The second track is the stakeholder evidence. I use the analytical network process because ESG criteria are interdependent. Governance affect whether environmental claims are credible. social outcome depend on enforcement. A simple hierarchy would assume independence, but the research problem is precisely about interdependence. At one point in this thesis process, my supervisor asked a question that stayed with me. What if the disagreement between the two methods is the finding? The question changed everything. The econometric tell us when ESG is priced, the NP tell us why stakeholders believe it should matter. The distance between these two is the institutional gap with the same clarity. The sample covers 6 jurisdictions, 20 years and 54 expert judgment. The purpose is not proportional representation, it is maximum variation. Malaysia, Indonesia, Saudi Arabia, the UAE, Turkey, and United Kingdom represent different legal tradition, regulatory system, market depth, and Sharia governance arrangement. Some are large issuers, some are institutionally influential despite small issuance volume. The contrast is exactly why they are useful. The most surprising result is the United Kingdom. It has issued only a small volume of sukuk compared with Malaysia or Indonesia, yet it emerged as the most influential jurisdiction in the NP network. This tells us something very important. In ESG sukuk, credibility can matter more than scale. For Indonesia, this finding shouldn't discourage us, it should discipline us. Indonesia has genuine achievement, sovereign green sukuk, retail green sukuk, and cash wakaf green sukuk, but pioneering is not the same as influence. Influence requires outsider to trust not only the instrument, but the entire verification system behind it. Exploratory data analysis is not decorative in this thesis. It is staged tell us which model are defensible. The data show 3 important features. First, sukuk yield are not normally distributed. They show skewness and tail behavior, especially around period of the global stress. Second, yield are persistent. Past yield continue to influence current yield, which means a static model would attribute inertia to other variable. Third, pooling the country is not appropriate because cross-country heterogeneity is structural. Its finding has methodological implication. Non-normality justifies distribution-sensitive methods. Persistence requires a dynamic specification. Structural heterogeneity requires fixed effects. This is why I say that mean is not the market. The average can hide what happened under stress. If ESG matters during uncertainty but not during calm period, a mean regression might flatten two different truths into one misleading null result. That is why the thesis moves beyond average effect. At the conditional mean, the results are clear and honestly initially frustrating. Inflation matter, the large yields matter, but the SG variable don't react statistical significant at the mean. Environmental, social, and the governance proxy are all silent in the average model. I spent considerable time checking whether this was a data problem or specification error. It wasn't. The result is telling us something important. ESG is not yet operating as a continuous pricing factor in sukuk market. There is a technical interpretation. Fixed effects absorb slowing moving, institutional capacity, and time effect absorb global shock. But there is also policy interpretation that is harder to avoid. More framework, more disclosure document, and more sustainability language haven't automatically produced average pricing effect. That doesn't mean ESG is irrelevant. It means the market has not yet learned to price it continuously. The next question, therefore, is whether the signal appear under specific regime rather than the average. This is where the evidence becomes more interesting. When I move from the mean to quantile regression, the ESG signal begin to appear. Carbon exposure, life expectancy, and the market depth become significant in the lower and upper part of this yield distribution, but not at the median. 3 variable, 3 ESG-related dimension, 1 similar pattern. This pattern is difficult to dismiss as random. It suggests that ESG is not a constant discount. It is a selective signal that becomes valuable when investors need differentiation. In low-yield regime, investors compete for quality and use ESG-related information to spread strong credit from similar alternatives. In high-yield regime, uncertainty rise, and investors ask harder questions about institutional resilience, governance, and the real exposure. The implication is powerful. ESG wasn't absent. We're looking for it in the wrong place. The mean could not see a signal that becomes visible only when the market selectivity intensifies. This slide contains the central contribution of this thesis, the dual-layer pricing mechanism. The first layer is baseline compensation. It is driven by macroeconomic risk, especially inflation, and by yield resistance. This layer operates continuously. It sets the general cost of capital. The second layer is selective differentiation. This is where ESG enter, but it doesn't enter as permanent and universal greenium. It's enter under condition of uncertainty when investors needed credible information to distinguish between issuers. So ESG sukuk is best understood not as a constant yield discount, but as a form of style insurance. It becomes valuable when the credibility itself becomes scarcity. This has a very practical implication. Verification cannot be improved during a crisis. When the market are calm, investors might not pay much attention. But when the market are stressed, they suddenly care deeply, and by then it is too late to build trust. Credibility must be constructed before it is needed. This is why regulation, assurance, and post-issuance verification are not administrative burden. They are the infrastructure that allow ethics to become financially legible. The stakeholder track tell a different but complementary story. The experts are individually consistent. Their consistency ratio are excellent, which means their judgments are not random. Each group has a coherent view of what matters, but they don't agree with each other. Academic emphasize long-term systemic risk. Industry professional emphasize auditability and transaction feasibility. Regulator emphasize enforceability and policy relevance. This is not a weakness. It is the finding the ESG Sukuk market doesn't yet have one shared paradigm. It has several coherent professional worldview using the same language but prioritizing different things. This matters because market requires coordination. If regulators, scholar, practitioners don't share a common understanding of what credible ESG Sukuk should mean, then the signal remains fragmented. The solution is not to force everyone into one opinion. The solution is to build standard verification process and reporting conventions strong enough to translate different priority into a common market language. The country priority results are among the most counterintuitive findings of this thesis. The United Kingdom ranked first across all stakeholder groups, despite having a much smaller sukuk market than Malaysia, Saudi Arabia, or Indonesia. Why? Because credibility in this context follow legal predictability, disclosure quality, and institutional trust. This is a crucial reason. Volume can create visibility, but credibility creates influence. The Indonesian research deserves carefully reflection. Industry professionals see strong potential in Indonesia, but the regulatory weighting is more conservative. I don't read this a criticism of Indonesia. I read it as a diagnostic signal. Indonesia has pioneered important instruments, including sovereign green sukuk, retail green sukuk, and cash wakal green sukuk, but the NP results suggest that pioneering hasn't yet been fully converted into priced institutional authority. For Indonesia, the next stage is not simply to issue more, it is to make our claim harder to do, our impact easier to verify, and our standard more legible to international investors. The NP results show a powerful convergence around governance. Corporate governance, regulatory compliance, and climate change mitigation sit at the top of the system. Income distribution, human rights, and social responsibility sit near the bottom. At the cluster level, environmental and governance criteria dominate, while social criteria receive much less influence. The governance result is not surprising in one sense, but it is very important. It's aligned with the econometric result where the market depth and governance credibility appear in the tail of the yield distribution. Two independent methods point to the same conclusion: governance is transmission channel. However, the social result is more troubling. Social through which influence accumulate in the network. That distinction matter. If the problem were merely preference, we might try to persuade people to care more. But if the problem is network structure, then the solution is institutional design. Social criteria need a contractual hooks, measurable indicator, verification pathway, and consequence when targets are missed. This is the most uncomfortable finding of the research, and I want to present it honestly. Classical maqasid give moral priority to life, intellect, lineage, and welfare, yet in the ESG Sukuk priority structure, income distribution and human rights sit at the floor of the system. The market hasn't intentionally rejected social objectives, but it has made them structurally peripheral. Why? Because carbon can be measured in ton, governance can be traced through board structure, audit report, and compliant filing, but human dignity, income justice, social resilience are harder to quantify and harder to enforce. In a system where influence accumulates through measurability, the less measurable become less powerful. That is the social deficit. But I don't see this as a reason for disappear. I see it as a design challenge. If social objectives are made measurable, contractually binding, and independently verified, their position in the network can change. The task is not preach social justice more loudly. The task is build instruments that allow social justice to be seen, audited, priced, and report. Each jurisdiction in the study teach us different lessons. The United Kingdom teach us credibility can outweigh issue and volume. Malaysia teach us a prospective framework, credible incentive, and clear enforcement create international trust. The UAE teach the importance of market infrastructure and feasibility. Saudi Arabia teaches the power of strategic scale when aligned with a national transformation agenda. Turkey teach that historical Islamic institutional depth doesn't automatically translate into contemporary ESG credibility. Indonesia teach perhaps the most important lesson for us: innovation must be followed by institutionalization. We have pioneered instrument that the world should notice, but pioneering we have genuine achievement. Indonesia issued the world's first sovereign green sukuk and the first retail green sukuk. We have large cumulative issuance, and the cash wakaf link sukuk is a remarkable innovation that integrates Islamic finance with the social and the capital market. But pioneering doesn't automatically produce influence. ESG sukuk still represent a small share of our issuance, and Indonesia's position in the NP network is below what our innovation record should justify. The issue is not that Indonesia lack rules. We have Ph.D. 18-2023, the Sustainable Finance Taxonomy and the Sustainable Capital Market Roadmap 2026 until 2030. The architecture at the front end is already strong. The gap is what happened after issuance. Allocation reporting exists, but independently verified impact reporting remain thinner. Interagency coordination can be improved. Waqf administration remain decentralized. Some taxonomy classification remain debated. So my message is simple. We built the front door beautifully. Now we must strengthen the back door. The world is not only asked where the money was allocated. It will ask what changed because the money was spent. For regulator, I offer this recommendation with respect and with the constructive spirit. First, prioritize governance before expanding disclosure volume. More indicators are not always better. Fewer indicators, independently verified, and can create more trust than a large taxonomy without a strong assurance. Second, on a post-issuance enforcement, the market needs to know not only what qualify at issuance, but what happened after the funds are used. Mandatory third-party impact verification and the public deviation reporting would sustainably improve credibility. Third, condition, standardized CWLS impact reporting, and consequence for missed social target can make social performance financially visible. Fourth, evaluate policy using distribution sensitive tools. If ESG matter most in detail, average effect evaluation will the mechanism. Regulator needs stress-based and quantile-based assessment. Finally, Indonesia should actively shape international standards such as IOFI Standard 62. As one of the world's major sukuk market, Indonesia should not only receive rules, it should help write them. For investors, the lesson is practical. Don't assume that ESG sukuk automatically deliver a permanent premium. The evidence doesn't support that assumption. ESG should be priced as credibility under stress, not as guaranteed discount in normal condition. Second, building screening system before the crisis arrives. ESG information becomes most valuable precisely when the market are anxious. But that is also when information is hardest to verify. Serious investor must do the work in calm period. Serious investor must do the work during calm period. Third, focus on verification rather than label. A green or sustainable label is not only the beginning. Investors should ask the post-issuance impact report, independent assurance, and clear consequence if targets are missed. Four, recognize that investor discipline is part of the enforcement mechanism. If investor reward weekly verified in the same way they reward strongly verified sukuk, issuer will have little incentive to improve. For Muslim investor, the obligation is even deeper. A Sharia compliance structure is necessary but not sufficient. The contract must be sound and the outcome must also be morally defensible. For academic, especially doctoral students, this research opens several paths. First, we should move beyond repeatedly proving that ESG and Maqasid are compatible. That argument is important, but it is no longer enough. The more urgent question is transmission. Why values that are compatible in principle fail to become visible in pricing, reporting, and governance? Second, future study should model governance as the channel through which environmental and social criteria become priced. Interaction term between governance, E or S variables should produce a much sharper understanding of ESG sukuk materiality. Third, the field urgently needed post-issuance impact data. Whoever built a credible data set or realized ESG outcome for sukuk over 5 or 10 years will define the next stage of scholarship. Indonesia is especially well positioned because of its long sovereign green sukuk experience. Four distributional methods should become standard in the market with normal yield. Quantile regression is not an optional appendix. It is often the proper way to see how pricing changes across regime. Finally, mixed method in Islamic finance should become more rigorous. Decision science tools such as NP can allow stakeholder judgment to carry real analytical weight rather than functioning as decorative interview material. Let me close the analytical part by reducing the thesis to 5 defensible propositions. First, ESG relevant in sukuk market is conditional. It is not universal, automatic, or continuous. Second, sukuk pricing operate in 2-layer macroeconomic risk asset, the baseline, while ESG differentiate selectively under uncertainty. Third, governance is the transmission channel, but the econometric and NP track point in that direction. Four, social criteria are structurally underweight because they lack measurable and enforceable hooks. Fifth, ethical alignment is necessary but not sufficient. The final sentence is that one I would defend more strongly. Being right is not the same as being legible. Islamic finance must possess a rich ethical foundation, but market can only price what institutions make feasible and credible. Personally, I began this research wanting to prove that ethical superiority of Islamic finance. I ended with a more mature conclusion. The is real, but it is really unfinished. That is not discouraging. It is a work agenda. It tells us exactly where the next generation of Islamic finance must build. Let me close as we begin with the gratitude, humility, and dua. Allahumma inna nas'aluka ilman nafian wa rizqan tayyiban wa amalan mutaqabbalan. A thesis can be defined, bound, cataloged, then forgotten. But ilm nafi is different. Beneficial knowledge moves something in the world. It changes a decision, reform an institution, discipline the market, protect a community, or give the next researcher a better question. That is what I ask Allah for today, not merely that this work be complete, but that it become useful. I am grateful to my supervisor, Associate Professor Dr. Hakan Aslan, to the academic jury, to Sakarya University, to the Türkiye Burslara program, to the expert who contributed to the NP, and to my family whose passion carried this research in way no dataset nor can record. And I close this with this invitation. Please don't receive this presentation passively. Test it, question it, disagree it, improve it. The institution we haven't yet built. Wa akhiru da'wana alhamdulillahirabbil alamin. Thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.